Inheritance is one of those things that is a very, very tricky situation. When you receive it, when you've been notified that you're going to receive money, please do not run out the door and begin to move accounts, spend money, make investment decisions. Those are all bad plans. You've got to do this in the right order, in the right steps. The tax consequences are not minor. They can be major. We're going to talk about this next on Consider This program. But for you, I would recommend going to yourlifeafterwork.com or calling 1-800-928-4001. Get signed up for a Next Steps meeting. We'll invest 90 minutes with you, complimentary. We'll give you things to consider today, things you're going to want to consider in your future, and if we choose to partner together, we'll tell you what FEG will do for you, and we'll put it into writing. We take care of people who don't want to worry about their money. I hope that's you. I know it's me, and we're fiduciaries. We're happy to do our job, but give us a call, 800-928-4001, and go to yourlifeafterwork.com. Welcome back to Your Retirement Playbook. I'm Joe Clark, your host. Should I tell my parents? Yeah, that is the title or theme for this show, for all these segments. And it is that inevitable question that we all have. Should I pay the price of pain today or suffer the price of regret later on by not telling them? Well, in this question, this is very, very, very serious. I don't like bad, ugly stories, but I got to tell you this one and just get to the chase. So I've taken care of a family. He actually passed away probably in 2006, 2005. So you'd think in 35 years of doing this and the 15 or so years since then that there would have been a worse story. Maybe not. You may make the headlines someday if I find out about it. But in this case, I had taken care of a mom and a dad and a daughter for about 15 years. And they had money because we understand at the Financial Enhancement Group the value of tax diversification. They had money in an IRA and they had money in an after-tax account. The after-tax account was held at a brokerage firm. They don't kindly notify you when somebody has passed away, by the way. That's left up to the financial advisor to take care of that notification and that process. If you're doing it on your own, then you've got to call them yourself. If you're doing it with us, we obviously do it. But if you have an insurance product, and in this gentleman's case, he had an IRA that happened to be in an annuity. That means it had a beneficiary designation attached to it. And so the insurance company actually mailed something out to the beneficiary. Remember, I've told you before, do not, breathe deep, right? Pause, breathe, center, enter, right? You do not want to overreact. Someone's lost. You've already got emotional challenges that's there. But you get this thing in the mail and it says, hey, we have, and in this case, almost an identical amount of money to pay off their house. Now, they didn't know because they didn't call me. They didn't know that they also had an identical amount of money that was coming that was in an after-tax account. And remember, with after-tax money, if you pass away, your beneficiaries receive a step-up in basis, meaning there's not even capital gains tax. So in this case, they could have taken the whole $287,000 out of the brokerage account, paid off their house, and paid zero in taxes. But no, that's not what happened. What happened was they told the insurance company, sure, we'll take the $287,000. The insurance company sends them a check for the $287,000. I think the insurance company, though I don't know, asked them if they wanted any withholding. I don't know if they knew what withholding meant or didn't mean. One was an engineer, and I can't remember what the other one did, the husband and wife. But they get the check for the $287,000. No tax has been taken out of. They take the $287,000 check. They give it to the bank, and everything is fine and dandy. The house is paid for. They now have the deed. Congratulations. One would call this a great success until it was time for taxation, and they get a 1099. For the $287,000, fully taxable because the money had been pulled out of the IRA all at one time, added on top of their income for the year, right? Added on top of their income for the year. So yes, they've got the $287,000. They were almost identical amounts in the brokerage account. They still get it with no taxes on it, but they're madder than hornets. that they have to pay the taxes on the IRA. So they start off with, why didn't you tell me? Then the wife reminds the husband that he did it without calling me. And so, okay, all right, I get that. Well, can you fix it? And the answer is, ladies and gentlemen, there is no fix. The IRS simply says, in some cases, there is no fix. We understand you made a mistake. We understand you shouldn't have did it. Did it? Great English. But the key is you did do it, and there is no going backs. Once you inherit money from an IRA, if you touch the money, it is taxable. If you have money that goes trustee to trustee, it goes from Schwab to TD Ameritrade, fine. Goes from an annuity to TD Ameritrade, fine. But if that money goes to your house and you cash that check or it's made payable to you, bad things will happen to your tax return, and bad things did indeed happen to them. If you're going to inherit an IRA, you want to be thinking this through, and you want to have strategies, and you want to understand the tax implications along the way. So point number one that I'd like to make, the probability that you're going to inherit an IRA is increasing. Now, we know about 70% of the time men in a marriage die first. I won't bore you with any of the jokes. They're there, plenty of them. You can Google them, I'm sure, and find them. But 70% of the time, the dad dies first, leaving behind mom. If dad had a 401k, mom receives the 401k in the form of an IRA. If you're the kids, odds are you are a beneficiary. So 20 years ago, the probability was mom and dad didn't have an IRA, or it was a small IRA or a small 401k that had already been exhausted, or the amount of money that you inherit was de minimis. Today, I've got over 100 people that have more than $1 million in IRA accounts. And in many cases, if we hadn't been involved, the kids have no clue mom and dad have that much in resources. And in many cases, still don't. Mom and dad just can't bear to tell the kids that they saved and accumulated $2 million. I'll go into that in another reason. But the kids are going to inherit that amount of money. The probability is, as a beneficiary, you are going to receive tax-deferred money. What does tax-deferred mean? Tax-deferred means nobody's paid taxes on it yet, but you will be as the beneficiary as you use it, just the way that the deals work. So not all assets are created equal. If you're going to inherit money, you want to make sure that you understand the buckets the money fall into. Basis, whenever you hear me use that word, basis is how much money is in an account that has already been taxed. How much money is in an account that's already been taxed. There is only one basis that you care about when somebody dies, because right now, under the current code, you get a step up in basis on that brokerage account. So if mom and dad bought the famous fruit company, Apple, at $6 a share back in 2006, that's a split adjusted, of course, and today it's worth $130. And they pass away, you get a step up in basis on that money. If it was in an IRA, there is no step up in basis at all. You simply have to deal with the distribution, whether it was Apple or whether it was another stock or whether it was a CD. It's immaterial. Any of the money leaving the IRA will be taxed. Now, the only basis that you care about, again, that's money that you've already paid taxes on, is inside of an IRA. Now, most people do not have basis inside of IRAs, but it is the taxpayer's obligation to make sure that they keep track of that money. Your CPA is likely helping you along the way, your parents along the way, but it is important that you ask, do you have basis in your IRA? When they pull money out, a portion is taxable, a portion is not, if they have basis. That's one of the ways to kind of check to see. But that's the only time you really care about basis. In terms of required minimum distributions, if they are over the required beginning date, which is age 72, when they pass away, if it's an IRA, they will have to take on their tax rate a required minimum distribution for that year. Right? Other than that, no problem, no harm, no foul. The money moves into your name once their RMD is taken care of. If they pass away before turning age 72, there is no required minimum distribution on their behalf, and you don't have to worry about that. It can be rolled into an IRA in your name as an inherited IRA. It cannot mix with your other inherited or with your other IRA money. If you lost mom and you lost dad, you have two inherited IRAs. They cannot mix. They were two different people. So technically, you have an IRA for your benefit that was in your dad's name, and an IRA for your benefit that was in your mom's name. Now, once you inherit the money, the new rule is you have a 10-year period of time. You have no required minimum distributions. if they died before what we call the required beginning date for your parents, they were not 72 yet, you have 10 years to be able to pull the money out over, based on your life expectancy. But you have to pull the money out, and it has to be exhausted at the end of 10 years. But you can pull it all out in year 9 or all out in year 1. There is no penalty ever for taking money out of inherited IRA, but there is full taxation if it was tax deferred. Now here's where it gets to confusing. If they were past age 72, right, 72 or beyond, 72 in day 1, they had required beginning distribution. They had the required beginning date. They had to take RMDs, and so do you. So even though your account has to be exhausted at the end of 10 years, you're now taking money out, RMDs out each and every year at the bare bones minimum based on the amount of money, the life expectancy that they would have attained. It gets to be very, very complicated and complex. We spent a couple hours on this at the last Dead Slot meeting. Me and 400 of my closest friends, those are CPAs, tax attorneys, and jerks like me or geeks like me that just like to read tax code and understand what's going on. So the story here, the theme here is you don't touch the money. And what I do with people is I try to help them forecast taxes and tax rates. So how do you forecast taxes? Well, I look at me at 55 years old. I still have a long runway left in my career. Unless something happens in the business, which I don't anticipate, for the probability of my tax rate going down is very minimal for an extended period of time. All right, so if I were to inherit money from my mom, my father's already passed. If I were to inherit IRA money from my mom, I would expect to pay a higher tax rate right now over that 10-year period of time than my mother likely would. That means it behooves me to get my mother to take the money out of the IRA at her tax rate, not mine, even if it means I'm giving her a gift today to pay the taxation on the money. Now, I understand that's a chess piece game, but those are the kind of things that we think about at the Financial Enhancement Group, and they're things that you need to consider. If mom and dad have an IRA that they're not using and aren't living on a lot of money, and the only RMD that they're taking out is to give to the church in the form of a QCD or a qualified charitable distribution, it would behoove you to give them money if necessary to pay the taxes. We call it bracket bumping. So it's not an all in one year. This is not just go do it. Remember, we're all unique, right? This is my opinion. This is a strategy. I still strongly encourage a fiduciary. It'll be a CFP and a CPA working together, collaborating to give you the best answer from mom and dad and the best strategy. And this is long before they get ill and get to point of demise. The point is you have options, but you need answers, you need a strategy, and you need to do something with it. Go to yourlifeafterwork.com and get more.